welcome to the deep dive. Today we're plunging into Albemarle Corporation, ticker symbol ALB.
Yep, a company that's really right at the center of this whole global energy transition.
Exactly. And before we jump in, just a quick note. This analysis comes straight from our friends at Stock Analytics AI.
That's right. You should definitely check out their YouTube channel.
Yeah, like and subscribe. And get this, members, for just $4.99 a month, get priority deep dives on specific tickers they request. Pretty neat.
Definitely worth checking out.
Now, for our deep dive today, we're really grappling with, well, a fundamental question, isn't it?
It is. Is Albemarle set to really harness these huge multi-decade tailwinds from the energy transition, create massive long-term value?
Or is it sort of stuck, a cyclical giant vulnerable to the same price swings it helps create?
That's the core tension, and we'll aim to give you a clearer picture by the end of this discussion.
Okay, let's set the stage.
Right. Our analysis is based on information available as of June 20, 2025. Albemarle closed at $58.41 a share on June 19th.
Got it. And how are we structuring this?
We've split it into two parts. Part one covers the core business, the management, and the financials.
And part two?
Part two looks at market sentiment, who owns the stock, the risks involved, and then we'll wrap it up with our conclusion.
Sounds like a plan. Let's get started then. Part one, the core, business, leadership, and finances. Chapter one, business understanding. Okay, chapter one. Let's kick things off with Albemarle's core operations. What exactly does this company do? How does it make money?
Well, Albemarle operates a pretty sophisticated, vertically integrated business model.
Vertically integrated, Mimi.
Meaning they control the process from start to finish, essentially. They transform essential mineral resources into high-value specialty chemicals.
Oh, yeah.
And this integration, especially you see it in lithium, it gives them control over the entire value chain, from digging the raw material out of the ground at sites across the globe to manufacturing and delivering the purified final products. Revenue comes mostly from, direct sales of these chemicals.
Any stability there? Or just spot sales?
There is some stability. They have long-term supply agreements, some stretching out 3, even 10 years, so that helps smooth things out a bit.
And how's the company organized internally? What are the main divisions?
As of fiscal year 2024, they operate in 3 primary segments.
Okay.
First, energy storage. This is their largest unit, 56% of net sales, focused on lithium compounds for rechargeable batteries.
The EV boom stuff.
Exactly. EVs, consumer electronics, energy storage systems, all that.
What's next?
And then there's specialties. That contributes about 25% of net sales. This segment handles bromine and bromine-based derivatives.
Bromine used for?
Oh, diverse industries. Fire safety, oil and gas, water treatment, pharmaceuticals. It's quite varied.
Interesting. And the third?
The third is Ketjen. Makes up the remaining 19% of net sales. This part provides catalyst solutions.
Catalysts, like for refining.
Precisely. Things like hydroprocessing and fluidized catalytic cracking catalysts, essential for making cleaner fuels and improving refining efficiency.
Gotcha. Now, I heard there was a significant strategic shift recently in how they operate. What was that about?
Yes, that's right. Effective November 2024, they actually shifted from having distinct global business units to a fully integrated functional model. This was a really decisive move, a direct response to that severe downturn in lithium prices we saw.
Cutting costs.
Exactly. By centralizing key functions, think procurement, manufacturing, supply chain, the company aims to eliminate cost redundancies and drive efficiencies. They're targeting, I think, $300 million to $400 million in annual cost and productivity improvements.
Wow. Okay. So within these segments, what are some of the key products that make Albemarle so critical?
Oh, their portfolio is highly specialized. For energy storage, the big ones are lithium carbonate and lithium hydroxide for lithium-ion batteries. We're talking high-purity battery-grade materials.
Right.
But also things like spodumene, lithium metal, even advanced compounds used in, believe it or not, rocket propellants and pharmaceuticals.
Oh, okay. And the specialties?
In specialties, think flame retardants like their Satex brand. Also, clear brine fluids for oil and gas, that's Wellbrom, and biocides like Avibrom and Sanabrom for water treatment.
And the catalyst segment?
Ketjen provides hydroprocessing catalysts, HPCs, and fluidized catalytic cracking FCC catalysts. Really crucial stuff for cleaner fuels.
So where does Albemarle actually stand in terms of market position and scale in these specialized areas? Are they, a big fish in a small pond, or...
They hold a really commanding position. Albemarle is one of the world's largest, most influential suppliers of lithium, consistently ranked fourth largest producer globally as of April this year.
Good.
And in bromine solutions, they are an undisputed industry leader. Their scale is global, over 25 production and R&D facilities, serving around 1,900 customers across, 70 countries.
Wow.
So while their overall market share in the broad chemical space might seem small compared to commodity giants, their real strength is dominating specific high-value niches. We estimate about 25% global market share in lithium.
A quarter of the market.
And a formidable 35% in bromine.
That's significant. So that leads to the question, what's Albemarle's core value proposition? Why do customers choose them?
Their value proposition is pretty clear. It's about reliably transforming essential natural resources into highly customized, performance-critical ingredients.
Okay.
This is built on a few pillars. Where consistency is everything.
Makes sense.
Then there's technical expertise and innovation.
Right.
They've got over 250 active patents, significant R&D spend,
Right.
and increasingly important, a strong commitment to sustainability and responsible stewardship. That matters a lot to their major customers, like the big auto OEMs.
Okay, looking at the bigger picture now, what are the key market trends and growth potentials for each of Albemarle's segments? Where's the action?
Well, the lithium market is where the real drama is. It's extremely cyclical, as we've said. It's just now emerging from that severe downturn in 23-24. Prices just collapsed due to a temporary supply surplus.
Yeah, it was brutal.
It was. But the long-term outlook, exceptionally strong. Global demand grew 30% last year alone. Supply is getting rationalized now. Meaning less efficient producers are cutting back or shutting down. Analysts project the market will tighten up this year, 2025, and potentially swing to a deficit by 2026.
A deficit, so prices could rebound.
That's the expectation. And longer term, lithium demand is forecast to more than double between 2024 and 2030. That's a powerful secular tailwind.
Okay, that's lithium. What about bromine?
The bromine market is more mature, more stable. It's projected to grow from around $5.7 billion in 2025 to maybe $8.5 billion by 2029. That's a compound annual growth rate of about 10%, driven by fire safety, oil and gas, water purification, steady growth.
Then catalysts.
The catalyst market is also pretty established, forecast to grow from roughly $42 billion in 2025 to $52 billion by 2029. That's a CAGR of about 5.4%. Driven by petrochemical and refining expansion, plus environmental regulations demanding cleaner processes.
All right. What about the competition? Who are Albemarle's main rivals in these different arenas?
In lithium, competition is intense. You've got the established producers like SQM, Ganfeng Lithium, Tianqi Lithium, also diversified miners like Rio Tinto getting involved. But a really significant evolving threat is vertical integration by the automotive OEMs themselves.
Like Tesla.
Exactly. Tesla is now listed as a direct competitor. This could potentially cap the pricing power of independent producers like Albemarle in future upcycles. That's something to watch.
Definitely. And in bromine and catalysts.
There, they compete mainly with other large, diversified chemical companies. Less direct, maybe, but still competitive.
How does the regulatory environment impact Albemarle's business? It must be complex with mining and chemical manufacturing.
No, it's very complex. Mining faces increasingly strict regulations, environmental impact, water usage, land reclamation. Getting permits for new mines is a long, rigorous process.
That hurdle.
Definitely. And EPA approval for new chemicals in the U.S. can also slow down innovation. However, this complex framework also acts as a barrier to entry for new competitors. It protects the incumbents to some extent.
Interesting angle.
Plus, some policies like the U.S. Inflation Reduction Act, the IRA, directly benefit Albemarle. Remember, they operate the only lithium-producing mine in the U.S.
Right, in Nevada.
Exactly. And they've received government grants to support expanding domestic production because of the IRA.
Summing that up, what are the key barriers to entry that protect Albemarle in its niches?
They are pretty formidable, actually.
Like what?
First, resource control and capital intensity. Just getting access to high-quality mineral deposits is hard. Then you need billions of dollars to develop them. That's a huge hurdle.
Okay.
Second, technical know-how and IP. Decades of expertise, that extensive patent portfolio. It creates a real knowledge barrier.
Makes sense.
Third, high customer switching costs. Their products are highly engineered components. Changing suppliers is costly and risky for customers, especially when the chemical cost is tiny compared to the final product. like a car battery.
Right. You don't want to mess with quality there.
Exactly. And fourth, those regulatory hurdles we talked about, they create a substantial barrier for new entrants.
And what about Albemarle's distinct competitive advantages? What really makes them stand out beyond just barriers?
Well, their brand strength is significant. Built over 150 years, it's synonymous with quality, reliability. Time magazine even named them one of the 100 most influential companies in 2023.
That's quite an accolade.
It is. But their most durable advantage is probably their structural cost advantage.
From those resources.
Yes, from their world-class resource bases. Think Chile's Salar de Atacama, Australia's Greenbushes. These are among the lowest cost sources of lithium production globally.
So they can make money when others can't?
Essentially, yes. It allows them to remain profitable even when, say, roughly a third of the global industry is operating at a loss. That's a huge advantage in a cyclical market.
Wow.
Then add in those high customer switching costs, creating a loyal base and pricing power, plus unique assets like being the only U.S. lithium mine and their R&D muscle. It all cements their leadership position.
Chapter 2, Management Evaluation. Okay, let's turn our attention now to the leadership at Albemarle. Chapter 2, Management Evaluation. How has the CEO, J. Kent Masters, who came in April 2020, and his team navigated the significant challenges they've faced recently?
Masters' tenure has really been defined by his response to major disruptions, the pandemic, supply chain chaos, and most notably, that severe cyclical downturn in lithium starting in 2023.
Right.
During the pandemic, they actually maintained business continuity remarkably well, but the response to the lithium price collapse was key. They acted very proactively in early 2024.
What did they do?
Well, as we mentioned, they restructured to that more efficient, integrated model. They launched an aggressive cost reduction program aiming for $400 million in annual savings, and they're already close to hitting the midpoint of that.
Pretty quick progress.
Very quick. And they showed significant capital discipline. They cut 2024 capex by over $450 million and slashed the 2025 forecast by more than 50%, down to $800 million.
This is pulling back on spending hard.
Exactly. It shows a disciplined, cycle-aware approach, focusing on long-term health, not just growth at any cost.
Now, transparency and ethical conduct are crucial. How does Albemarle's management fare here, especially given there were some past issues?
Right. Albemarle maintains a pretty comprehensive investor relations program, lots of detailed public updates. Ethically, the big thing is that September 2023 settlement of Foreign Corrupt Practices Act FCPA violations.
Oh, I remember that.
Over $218 million in fines for bribes paid between 2009 and 2017. Importantly, that predates the current CEO, Masters.
Okay, that's key context.
And crucially, the company self-reported these violations. That's a critical mitigating factor. They then undertook extensive remediation efforts.
Like?
Eliminated third-party sales agents globally, overhauled practices, put in a unified ERP system, embedded compliance training throughout the organization.
Oh, it's comprehensive.
It seems so. Their compliance program was even named the 2024 Compliance Program of the Year, which suggests a genuine cultural shift towards ethics and compliance.
Okay. What about their capital allocation strategy? How did they decide where to invest, and how have they used M&A and divestitures?
Their main organic investment focus was expanding lithium production. But as we just said, they've shown discipline in pulling back during weak markets.
Right.
In terms of M&A, the big one was the 2015 acquisition of Rockwood Holdings for $6.2 billion. That was transformative. It brought them their world-class lithium business.
Right.
They've also done smaller bolt-on deals, like a lithium plant in China in 2022 for $200 million. And they've pruned the portfolio too.
Selling things off.
Yeah, strategic divestitures. They sold Chemetall Surface Treatment for $3.2 billion in 2016, Fine Chemistry Services for $570 million in 2021. Shows they're focusing on core businesses and strengthening the balance sheet when needed.
And their approach to returning capital to shareholders. Dividends, buybacks.
The dividend is definitely a cornerstone. Albemarle is a dividend aristocrat. Meaning they've increased their dividend for 30 consecutive years. Impressive streak. They just announced their 126th consecutive quarterly dividend payment.
Wow. What's the yield like?
The current annualized dividend is $1.62 per share, yielding roughly 2.7% at the current price.
Okay. And buybacks.
Share buybacks haven't really been a recent priority. In fact, in early 2024, they issued $2.3 billion in mandatory convertible preferred stock.
To raise cash.
Exactly, to shore up the balance sheet during the downturn, even though it was dilutive to common shareholders.
So that tells you their priorities.
It really clarifies their capital allocation hierarchy. First, sustain the business, CapEx, then maintain and grow the dividend, then fortify the balance sheet, and then maybe buybacks come last.
Got it. Finally, on management, let's look at return on invested capital, or ROIC. How's that metric looking?
Albemarle's ROIC is highly volatile. It perfectly mirrors those wild swings in the lithium market.
How volatile?
At the peak, December 2022, it was an exceptional 22.2%. But as prices fell, it just collapsed. It was 3.1% by December 2023, and currently the trailing 12 months figure is negative. About negative 9.86% or a negative 8% depending on the exact calculation.
Ouch. Negative ROIC.
Yeah, but that negative figure is a lagging indicator, right? It reflects the bottom of the cycle we just went through.
Yeah.
If you look at the 5-year average ROIC from 2020 to 2024, it was 6.8%.
Which is good. Bad.
Which is likely above their actual cost of capital. So it indicates they're creating value over the full cycle despite this extreme volatility. You just have to look through the cycle.
Chapter 3. Financial analysis. All right, let's dive deeper into Albemarle's financial health. Chapter 3. Financial analysis. Starting with some key metrics. Market cap, revenue trends over the last 5 years.
Sure. As of June 20th, 2025, Albemarle's market cap is hovering around $7 billion. That reflects the big stock price decline we saw with the lithium market downturn.
Right.
And revenue trends really illustrate that extreme cyclicality. You might see a 5-year sales growth rate reported around 8.4%, but that number masks huge volatility.
That's how so.
Well, revenue doubled to $7.1 billion in 2022, then surged to a record $9.6 billion in 2023, then plummeted to $5.38 billion in 2024.
Wow, what a drop.
Yeah. And the trailing 12-month revenue is around $5.1 billion, which is down almost 40% year over year. Q1 2025 revenue was $1.08 billion, down nearly 21% year over year. It's all about lithium pricing for the top line.
And their profit margins, following a similar roller coaster path.
Absolutely. Trailing 12-month, or TTM, margins are deeply negative right now. That's largely due to the bottom of the cycle hitting, plus a significant $604 million inventory write-down they took in Q4 2023.
So the numbers look grim on a TTM basis.
Yes. TTM gross margin is 3.5%, operating margin is 9.2%, and net profit margin is negative 25.7%. Ugly numbers.
But any signs of improvement?
Yes, actually.
Yeah.
Q1 2025 showed a return to positive margins. Gross margin was 14.5%, net profit margin was 3.8%. It suggests the worst of the write-downs might be behind them, and the cost-cutting is starting to bite.
Okay, that's encouraging. How has their free cash flow generation looked over the past 5 years? It's a capital-intensive business, right?
Very capital-intensive. So free cash flow, FCF, is heavily influenced by that capital investment. It was negative in 2019 and 2021 when they were investing heavily.
Then positive at the peak.
Exactly. At the peak of the cycle in 2022, they generated positive FCF of about $0.65 billion. But then in 2023, it swung back to deeply negative minus $0.82 billion because they continued heavy investment even as prices started falling.
And now?
Q1 2025 FCF was slightly negative, about matched $13 million. Management has made achieving break on FCF a key priority for 2025, mostly through those aggressive CapEx cuts we talked about.
What about earnings consistency? And how stable is the balance sheet debt liquidity?
Okay, earnings consistency, there isn't any. Let's be clear. The business is profoundly cyclical. TTM EPS is negative $11.12. That's a more than 500% year-over-year decline.
So don't invest based on consistent earnings.
Absolutely not. The investment thesis cannot be based on consistency here. However, their balance sheet looks pretty conservative and healthy.
How so?
The debt-to-equity ratio is low, 0.37. Long-term debt-to-equity is even lower at 0.32. They had about $6.7 billion in total liabilities against over $10 billion in total equity as of Q1 2025.
In short term?
Short-term liquidity looks strong. The current ratio is a healthy 2.11. That means over $4 billion in current assets against less than $2 billion in current liabilities. Plenty of resources to meet short-term obligations.
And that reliable dividend we discussed. How does that fit in? Does it look safe?
As we discussed, that 30-year history of consecutive annual increases demonstrates remarkable stability and a deep management commitment. Given the healthy balance sheet and management's clear prioritization of the payout, the dividend appears secure even in this challenging environment.
Okay, valuation. Traditional metrics like PE are useless here, right?
Well,
Negative earnings.
you got it. TTM/PE is negative, totally meaningless. For cyclical companies near a trough like this, you really want to look at asset and sales-based multiples.
Like price to book.
Exactly. Albemarle's price-to-book ratio is currently 0.88,
Wow.
meaning the market values the company at less than its accounting book value. That's often a classic indicator of deep market pessimism and potentially signifies undervaluation.
And price to sales.
Their price-to-sales ratio is 1.35, reflecting those depressed current revenues. Compared to a direct peer like SQM, Albemarle actually appears significantly cheaper on a book value basis right now.
Okay, let's unpack this valuation thing a bit more. If traditional metrics aren't working, how do we really try to gauge Albemarle's intrinsic value?
To estimate the fundamental intrinsic value, a discounted cash flow, or DCF, analysis is really crucial here.
Explain that briefly.
Sure, it basically involves projecting all the cash flows you expect the company to generate in the future, and then discounting those back to what they're worth today.
Sounds simple, but tricky for a cyclical company.
Exactly. The challenge with Albemarle is making reasonable assumptions about future growth and profitability through these volatile industry cycles. That's where the uncertainty lies.
So what did an educational DCF model suggest? And what were the key assumptions behind it?
Okay, based on a multi-stage DCF model, and remembering this is for educational purposes, the estimated intrinsic value of Albemarle stock falls within a range, a pretty wide range actually,
Yeah.
$75 to $115 per share.
Why so wide?
It reflects that significant uncertainty, especially around the timing and the magnitude of the lithium price recovery. A separate relative value model also put the estimate around $88, which falls comfortably within that DCF range.
What were the key assumptions driving that DCF?
Key assumptions included a three-stage revenue growth rate. First, -5% to +5% for 2025-2026. That's the trough period.
Okay.
Then accelerating to 10% to 15% growth for 2027 through 2031. That reflects the expected next upswing, driven by lithium demand doubling.
And long term?
And then a perpetual terminal growth rate of 2.5%, sort of in line with long-term economic growth. We also used a relatively high discount rate of WACC, or weighted average cost of capital, of 10%.
Why so high?
To compensate for the stock's high systematic risk, its beta is 1.61, meaning it's much more volatile than the overall market, and of course, the industry's inherent volatility.
Part 2. Market perception, ownership, risks, and conclusion. Chapter 4. Market sentiment. All right, moving into Part 2. We've dissected the business, management, financials. Now, Chapter 4. Market sentiment. How is the market actually perceiving Albemarle right now? What are the analysts saying?
Market sentiment is, it's a study in conflict, really. The consensus rating is generally hold or maybe moderate buy. The average brokerage recommendation is 2.41, kind of right in the middle.
But what about price targets?
That's where it gets interesting. The average analyst price targets are consistently well above the current share price of $58.41. They range from about $75 up to $85. That implies potential upside of, 28% to 46%.
Okay, so analysts see upside.
The range of those targets is extremely wide. The low target is $58, basically where it is now, and the high target is almost $163.3.
Wow, that's a huge spread.
It highlights profound uncertainty. It really feels like a show-me situation. The market is waiting for tangible signs of improvement, like higher lithium prices sticking, before re-rating the stock higher.
What's the general media tone? And has any recent news had a big impact?
News flow is pretty mixed. You see positive reports on their Q1 2025 earnings beat, their cost-cutting progress. You also see articles highlighting the long-term bullish case for lithium itself. But a significant portion of coverage remains cautious or even negative, emphasizing demand headwinds, the stock's poor recent performance. The overall tone just reflects an industry still working through a cyclical downturn.
Here's where it gets really interesting for me. Market indicators like short interest, what does that tell us about sentiment?
Short interest is exceptionally high, reported at 15.92% of the stock's float.
15%, that's huge.
It's dramatically higher than the peer average, which is more like 3% to 3.7%. The number of days to cover that short position is 5.4.
So what does that mean in plain English?
It indicates a significant concentrated bearish bet against the company. Albemarle is basically serving as a primary vehicle for people who want to bet against the lithium sector right now. It's a very crowded trade on the short side.
Which signals?
Deep pessimism, obviously. But it also creates the potential for a violent short squeeze.
Ah, right. If good news hits.
Exactly. If an unexpected positive catalyst emerges, those short sellers are forced to buy back shares to cover their positions, which can cause a rapid outsized rally in the stock price. High short interest cuts both ways.
Okay, and what do the technical indicators like the stock's price relative to its moving averages reveal?
Well, right now, the stock is hovering just above its 50-day simple moving average, or SMA. That's around $58. It suggests a period of consolidation, maybe some potential bottoming after that long decline.
But the longer-term picture?
The long-term trend remains clearly bearish. The stock is trading significantly below its 200-day SMA, which is way up around 75 or 81 fronters, depending on the calculation.
So it's well below the long-term trend.
Yes, the current price is about 28% below that long-term trend line. Confirms a major downtrend is still technically in place. For a technical trend reversal, you'd need to see the stock reclaim and cross decisively above that 200-day moving average.
Chapter 5. Ownership Structure. Let's look at who actually owns Albemarle. Chapter 5. Ownership Structure. What are the patterns in institutional ownership? A lot of big funds.
Oh, yes. Institutional ownership is exceptionally high. Somewhere between 96.5% and 97.1% of outstanding shares are held by institutions, over 400 and 350 of them.
And who are the biggest holders?
The top shareholders are dominated by the usual suspects: large asset managers, passive index fund providers. Think the Vanguard Group with about 12.5%, Capital World investors with 12.2%, BlackRock at 7.5%, State Street with 5.5%.
So mostly passive index money.
A very large chunk of it is. These largely price-insensitive investors create a stable, kind of sticky, long-term shareholder base, provide some support during downturns, but their ownership is mainly driven by index rebalancing, not really active valuation calls.
What about insider holdings? The execs and directors, are they buying, selling?
Holdings by company insiders are actually very small. Only about 0.34% of shares outstanding. The CEO, J. Kent Masters, for example, owns about 74,000 shares.
And the recent transactions?
There's a noticeable lack of conviction-driven buying. Over the past 12 months, there have been more sell transactions, 27, than buys, 17. And importantly, 0 open market buys or sells by insiders in the most recent 3-month period.
So no one's jumping in to buy at these low prices?
Not on the open market, no. The transactions reported were mostly automatic, related to equity compensation vesting and sales. The absence of significant open market buying at these multi-year lows, well, it's a neutral to negative signal. Potentially suggests they believe the market recovery might be more gradual.
And how concentrated is this ownership among those top institutions?
Ownership is highly concentrated. The top 25 institutional shareholders collectively own about 67.4% of the company, and the top 3 alone control over 32% of all outstanding shares.
Does that concentration pose a risk?
It means the actions or policies of just a few very large institutions could significantly impact the stock. But given that the largest holders are mostly passive index funds, it mainly contributes to that stable ownership base we mentioned.
Chapter 6. Risk Assessment. Okay, no deep dive is complete without hitting the risks head on. Chapter 6. Risk Assessment. Let's maybe frame this with a SWOT analysis. Strengths, weaknesses, opportunities, threats for Albemarle.
Good idea. Let's break it down.
Start with strengths.
Okay, strengths. World-class, low-cost assets, those premier lithium and bromine resources are key. Technical leadership with over 250 patents. A diversified business model with 3 segments providing some hedge. A strong, conservatively managed balance sheet. And an experienced management team that's proven itself in downturns.
All right, now, weaknesses.
Weaknesses. That extreme cyclicality of earnings, margins, and cash flow, all tied to commodity prices. High capital intensity needed for expansion, which strains free cash flow. That historical ethical lapse, the FCPA settlement, even with strong remediation, it's part of the history. And revenue concentration performance is heavily skewed towards the lithium market.
Okay, opportunities. What's the upside potential?
Opportunities. The immense, multi-decade secular growth trend in electrification. Lithium demand projected to double by 2030. That's huge. A potential looming supply deficit due to current industry disciplines setting the stage for price recovery. Favorable government policies like the U.S. IRA supporting domestic production. And always the potential for innovation into new markets or applications.
And finally, the big threats.
Threats. The primary, most significant one is lithium price volatility, period. Intensifying competition from established peers and those vertically integrating customers, the OEMs. Geopolitical risks, particularly China exposure, potential resource nationalism in producing countries. Macroeconomic headwinds like high interest rates dampening EV demand. And stricter regulatory and environmental hurdles always looming.
Let's elaborate on a couple of those threats. How do macroeconomic factors like inflation and interest rates specifically impact Albemarle?
Well, persistently high interest rates make financing more expensive for consumers, right? So that can make EVs less affordable, dampening demand. For corporate customers, higher rates might delay building new gigafactories or other big projects.
And inflation?
Inflation directly increases Albemarle's own input costs, raw materials, energy, labor. That can compress margins if they can't pass those higher costs along through price increases quickly enough.
And what about specific geopolitical factors, like those U.S.-imposed tariffs of 2025? Is that a big concern?
The U.S. 2025 tariffs on goods, including some chemicals and minerals, are definitely a key geopolitical risk to watch. However, and this is crucial, lithium carbonate and lithium hydroxide have been explicitly exempted.
Okay. So not a direct hit on their main business.
Management expects minimal direct impact on the energy storage business, as most of their lithium is produced and sold outside the scope of U.S. tariffs. They estimate maybe a modest direct hit of only $30–40 million on their specialties and Ketjen segments in 2025, which they believe they can largely offset anyway.
So the bigger threat is indirect.
Yes. The greater indirect threat is if broader tariffs on, say, Chinese-made EVs or battery components significantly increase the cost of EVs for American consumers. That could potentially dampen overall EV adoption and therefore long-term lithium demand. That's the bigger channel to watch.
Chapter 7, Conclusion. Okay, expert speaker. After this really deep dive, let's synthesize our findings. Chapter 7, Conclusion. First, give us the key bullish points, lay out the bull case for Albemarle.
Okay, the bull case rests on several strong pillars, I think.
Go for it.
First, unwavering secular growth. Albemarle is just smack dab in the center of the electrification megatrend. Lithium demand is projected to grow relentlessly for the rest of this decade. That's fundamental.
Right.
Second, a dominant and durable moat. Their ownership of the world's lowest-cost lithium and bromine resources gives them a structural cost advantage that allows them to survive downturns and actually strengthen their market position while weaker players struggle.
Very important in a cyclical industry.
Crucial. Third, disciplined, cycle-tested management. The leadership has shown a rational, effective approach to navigating this trough, cutting costs, slashing CapEx, protecting the balance sheet. They're positioning to emerge stronger.
Okay.
Fourth, compelling valuation. The stock is trading at a significant discount to historical multiples, analyst targets. That price-to-book ratio below 1.0 really signals potential undervaluation for patient investors.
And fifth.
Fifth, an inevitable cyclical turn. Maybe not tomorrow, but the current low-price environment is forcing supply-side discipline. That's setting the stage for a looming supply deficit and eventually a significant recovery in lithium prices in the medium term. It's the nature of cycles.
Okay, that's a strong bull case. Now, for balance, what are the key bearish points? What are the significant risks that could derail this bullish thesis?
All right, the key bearish points. First and foremost, extreme and unpredictable cyclicality. Those violent lithium price swings can just crush revenue and earnings, testing even the most patient investors' resolve.
Point taken.
Second, geopolitical and concentration risk. High exposure to China, potential resource nationalism in key producing countries like Chile or Australia. These are real, hard-to-predict risks.
Sure.
Third, intensifying competitive landscape. Fierce competition from peers isn't going away, and that threat of vertical integration by the auto OEMs is a significant structural headwind, potentially capping future upside.
Yep.
Fourth, macroeconomic headwinds. Prolonged high interest rates, a global economic slowdown. These could significantly dampen EV demand, delaying that recovery.
And finally,
negative market sentiment. You can't ignore it. The stock is in a clear long-term downtrend technically, and that exceptionally high short interest creates a significant headwind right now.
Got it. So to wrap up our valuation segment, can you just restate the estimated intrinsic value range from that educational DCF model?
Sure. Our educational discounted cash flow model estimated an intrinsic value range of $75 to $115 per share for Albemarle Corporation. Again, that's based on assumptions about a cyclical recovery starting around 2027 and using a 10% discount rate to account for the high risk.
Expert speaker, what does this all mean for our listener? Give us a final provocative thought to chew on as we wrap up.
Okay, here's the bottom line as I see it. As of today, Albemarle's share price, around $58, trades at a notable discount to even the low end of our educationally derived intrinsic value estimate, suggesting it may be significantly undervalued for an investor with a truly long-term time horizon and, critically, the fortitude to withstand what will likely be continued near-term volatility. You need patience.
The bet is on.
The investment thesis really hinges on a core belief that the powerful secular tailwinds of electrification will ultimately overwhelm these current painful cyclical headwinds. It's essentially a bet on a world-class company possessing irreplaceable assets and led by disciplined management acquired when market sentiment is near rock bottom.
But with significant caveats.
Absolutely. The substantial risks, extreme commodity price volatility, intensifying competition, complex geopolitics should not be underestimated. An investment in Albemarle today is a deep value, contrarian play. It requires patience, conviction in the long-term story, and an understanding that it could get worse before it gets better. It's a bet on the essential elements needed for our electric future.
That is definitely a lot to consider. Hopefully you, our listener, feel much more well-informed about Albemarle now. What stands out to you from this deep dive? Definitely something to mull over as you go about your day.
Food for thought, for sure.
And hey, don't forget to like and subscribe to the Stock Analytics AI YouTube channel. Seriously, check them out.
Yeah, great stuff over there.
And remember, members can add stock suggestions for future videos right in the comments, and the team will pick them up. Priority access.
And one final crucial reminder from us. This analysis was generated by an AI system. It's for educational purposes only.
That's right. It should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely critical. Do your own homework.